Howdy everybody, Brian here from quantlabs.net. I wanted to go over the moving averages. So I'm about to show you, there's going to be three lines. We've got a green line, that's a moving average of 20, moving average of red for 50, and then an exponential moving average, the long-term one, of 200 for yellow. Okay, so these are what the charts look like. So you can clearly see for Brent, this is a daily moving average. So we have the so-called yellow, which is this, the 200-day, the 50-day in red, and then the green here, which is the 20. Now, before we get confused, I want to make sure we understand what the crosses mean according to Investopedia. In the theoretical days, when you look at these moving averages, this is considered a classic period for a fast moving. This is the slower moving. This is definitely the slowest moving average, that is. So when you look at these can be classic trading signals on the buy or the sell. But again, you don't use these exclusively. You use these as a condition for your to trigger potential entry, or just trying to see. Okay, here we go. So once again, we have these three different periods, right? So try to remember those. So here's the paragraph that I want you to remember. You can always find this at investopedia.com terms/m moving averages, or just Google it as I did. And what you'll find here is you have two average crosses. Rising moving average indicate the security is an uptrend, while a declining moving average indicates that it is in a downtrend. Upward momentum is confirmed with a bullish crossover, which occurs when the short-term moving average, so in this case a 20, crosses above a long-term moving average, so let's say the 50. This is really important to understand, depending upon the periods or time frames that you're looking at. So in this case, what we've got here is, let me just get rid of these trend line charts. So Brent is a good example of this. We have here the green, which is 20, and the 50, which is red. So as it says here, to indicate a potential bullish crossover when the short term, in this case green, crosses the red, which is the long term, as you can see here. So if we go back to the chart, we can clearly see that the short term green has crossed over, but in this case it's not exactly working as it should. But then this is a daily chart, but I would not use these three trends. Really what works is the yellow, the EMA, and maybe the 50. Okay, so if we were to factor in on the daily to use the 200-day, where the 200-day is higher and crossed over the 50-day, the red, which is a shorter term, in this case we have the opposite occurring. Downward momentum is confirmed with a bearish crossover when the short term crosses below the long term. Well, in that case, on the daily, we have that here. We have the daily, the red, the short-term 50-day has crossed over the yellow, which is the 200-day. So what happens? We've got a crossover right about here, somewhere in here. So that may indicate that we now have a downward trend. There's a little bit of a pop, but we know that it's going to happen. And how do we know that this is definitely on? Because these two diverge more, and you can see the wider they are, the steeper the decline. Okay, So you could say the same thing with the opposite. If the shorter term is up here, the longer term is down here, then we know we are in a strong uptrend. That's for moving averages. But when you move into the more 4-hourly moving average, again on the Brent, you might be able to see some examples here where typically on the 4-hourly you only want to focus on the 20-day and the 50-day only. So ignore the yellow, this one, because this is going to be so lagging far behind, but you just focus on the green, the yellow. Okay, so again, we know if we have the 50-day crossing over the 20-day, we know that we have a downward trend. But look what we could have here. We have a situation where the 20-day has not fully crossed it, but I bet you down here it has, and it could happen here. And that will mean a upward trend. So right here, these two may collide. So let's say if the 20-day does cross the 50-day, that can confirm that we definitely have an uptrend. But do know, because you're using an MA, a moving average, that the moving average can lag a little bit. But I bet you if you used an SMA, the simple moving average 20 and a simple moving average 50, this will be a lot more sensitive, and that this will confirm much earlier, I bet here, that there is an uptrend and it's there to stay for a while. So again, you can use these as a way to confirm your theory on crosses, to confirm, again, potential entry points in the market by these crossovers. Just wanted to highlight that and to fully understand it, which is quite a mouthful, I do realize. Just come over to the Investopedia and do a search for the moving averages, because that little paragraph will sum it up quite nicely. Okay, and again, on the shorter term periods, I would only use the MA20 and MA50 for the 4-hour and hourly. So I bet you again, if I look at the hourly right here for Brent, again, you can see using that same theory, you've got here the green, the short-term 20 does cross over the 50-day, and boom, what do you know? We have a confirmed trend up. And here we have another one. The green moving average 20 is crossing over the 50. And again, if that trend does, where the reverse happens, where the MA50 crosses over the 20, as in this case right here, we can see that it is going into a downtrend. Hopefully this will help you out. And again, in summary, use the MA20, MA50 for both the 1-hour and 4-hour charts, and then only for the long-term daily, use the MA50 as for your fast, and your EMA 200 for the long moving average. Hopefully this will help you out later.